Benjamin Graham, Security Analysis, Principles and Technique. Embark on an insightful journey into the world of security analysis as we delve into Security Analysis, Principles and Technique by Benjamin Graham. This book's summary highlights the essence of sound investments and the various methods used in the assessment of securities. It introduces fundamental concepts, such as intrinsic value and the classifications of securities, while also critiquing market analysis techniques. The book advises readers on the examination of company performance, dividend histories, earnings trends, and asset values to make informed investment decisions. Central to the book is the importance of keeping the principal safe and delivering an acceptable return, as well as adopting a well-organized and empowered approach to investment decisions.
The three functions of security analysis and sound investment. Security analysis is a process that determines sound investments, keeping principal safe and yielding acceptable returns. It has three functions: descriptive, selective, and critical, that involve presenting, judging, and monitoring securities. In contrast, market analysis attempts to forecast prices without reference to underlying company facts. Technical analysis and index-based analysis promote speculation over reasoned investment. Intrinsic value is a crucial concept in security analysis, defined by assets, earnings, dividends, and prospects, distinct from market quotations driven by manipulation or psychology. The classification of securities into two categories, stocks and bonds, fails to address their safety and purpose, leading to a more accurate classification of fixed-value securities, variable-value senior securities, and common stocks. A security that meets stringent safety tests and sells below its intrinsic value often proves profitable, while poor securities should not be issued or accepted. Unpacking firm financial strength. Investors need to assess the financial strength of bond issuers to determine their investment safety and potential. Investors must ask whether a company can manage its debts in difficult financial times or a scenario of recession or depression. Companies with dominant size within their industries and a robust margin of safety are more resilient. Preferred stocks and income bonds can also be secure investments with stringent safety requirements. However, investors must evaluate the guarantor's financial strength for guaranteed issues. Even though some bonds and preferred stocks do not qualify as safe investments, some issues in this category could still be worth buying if selling at a discount to their intrinsic value. Thus, investors should regularly assess their holdings to guarantee profitable returns. Attractive senior securities. Senior securities offer privileges such as conversion to common stock, participation in increased dividends, and option warrants for purchasing common stock. These privileges provide increased safety and potential price appreciation. However, not all senior securities are safe, and only a limited number meet investment-grade safety requirements. When evaluating these issues, investors should consider the profit-sharing benefits, proximity of the event-triggering benefits, and duration of the privileges. A diligent search can uncover undervalued investment issues. Investing in common stocks. Common stocks are riskier than senior issues but crucial to the U.S. financial system. The 1929 crash fueled the false belief that they were always a good buy, but in reality, their instability makes them a dubious investment. However, portfolio diversification can offset some risk. Investors should subject their common stocks portfolios to thorough analysis and consider three crucial factors. Investigate dividend rate. Before investing in common stock, it's crucial to investigate the firm's dividend rate and history of paying dividends. Higher dividends often correlate with higher stock prices, but it's important to remember that management can suspend common stock dividends at any time. Surplus earnings paid as dividends are worth more to investors than reinvesting in the business, and periodic stock dividends represent a return to shareholders. Lastly, unusual stock dividends often give investors nothing they didn't already own. Analyzing companies' earnings. The earnings of a company are crucial to determine its investment soundness. however, analysts have given them too much weight. A company's earnings can be manipulated by non-recurring charges and profits, lowering or increasing the reserves, and reporting subsidiaries' results differently. To examine a company's investment soundness, investors must analyze both the earnings trend and the long-term earnings average, preferably 7 to 10 years. Furthermore, the analyst's job is to make decisions based on facts, not predict trends or price changes. Thus, always scrutinize the firm's income statement with a critical eye, as modern financing methods can be executed in full view of the public without being much the wiser. Asset Valuation Guide. To determine a company's value, it's crucial to inspect its balance sheet. Its book value per share is calculated as the total value of tangible assets divided by the number of outstanding shares. In contrast to Wall Street's focus on earnings, asset value is a key indicator of a company's worth. It's vital to investigate a business's underlying asset value before investing, as it provides insight into the potential for undervaluation. Another critical number to keep in mind is current asset value, a rough approximation of a company's worth if it goes under. Investors who can differentiate between undervalued stocks and poorly performing ones can generate significant returns. A company's balance sheet should also be reviewed to ensure adequate cash, current assets matching liabilities, and no large debt maturing soon. As one of the most docile shareholders globally, Americans should be proactive in asserting their rights as owners of the business. Finance isn't altruistic. Shareholders versus management. Shareholders must educate themselves on management practices to make informed investment decisions, as the interests of management and shareholders may not always align. In cases where a company's stock is worth less than its liquidation value, liquidation may be the best option for shareholders but not for management who may lose their jobs. Analysis is important, but investment is not an exact science. Professional analysis is necessary, but investors should take established principles and logic into account when making investment decisions.
In conclusion, Security Analysis, Principles and Technique provides an invaluable guide to make prudent investment decisions based on facts and logic. It emphasizes the importance of understanding the difference between investment and speculation, and underlines the pivotal role of intrinsic value in security analysis. The book discusses various types of securities and their appropriate evaluation criteria, while underscoring the necessity of continuous critical analysis of companies and their management practices. It dissects market analysis techniques and censures the use of speculation in the marketplace. In essence, this book is a valuable asset for those seeking to cultivate a solid foundation in the world of investments and a must-read for individuals who aspire to develop a meticulous, fact-driven approach to their financial decisions.